Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. Good morning, Tyler. How are you?
Good morning, Dean. I'm doing great. How about yourself?
Good, thank you. Today we're going to talk about important financial terms. These are terms that you should know as a pre-retiree or a retiree, or as an investor. We're going to be talking about investment terms and retirement terms. These are some of the basics that we feel everybody should know, and the more you know about these basic terms, the better off you're going to be in retirement, or the better off you're going to be choosing some of your investments. So when it comes to the terms, let's look about investments here first. And these are things that we look at when we pick stocks. Now, our firm deals with many different types of investments: stocks, bonds, mutual funds. We also have some retirement planning products such as annuities, money market accounts, CDs, and so on. But when we look at stocks, people want to know what's our criteria for valuing stocks before we put them in a portfolio. Well, first of all, there are many criteria, but we're just going to look at some of the basics. So if you choose your own stocks, here are three basics that we're going to talk about. The first one is a PE ratio, a price to earnings ratio. You really need to know and understand what a PE ratio is, and it basically tells you whether the stock is cheap or expensive. And we'll talk a little bit more in detail about that. But understand, too, the terms that we're going to talk about today, 15 or 20 years ago, was very hard, and you had to do a lot of the figuring yourself to come up with some of the support to find out PE ratios and trading volume and things like that. But today, you can find most of this information, very reliable information, on some of the financial websites, and there are enough out there. I honestly like Morningstar. I like to go to Morningstar to get this information. It seems to be they're a little bit more middle of the road. They don't take a lot of political sides. They look at things in a vacuum. So we're looking at it from an investment standpoint and a risk standpoint. So we're going to start out today to look at PE ratio. Tyler, let's talk about the basics of PE and what we look for.
Yeah, Dean. So like you said, going over plenty of important financial terms today. And the first one that we're going to start off with would be PE ratio. PE ratio simply means price to earnings ratio, and what it is a ratio used for valuing a company, measuring its share price and earnings per share. So again, a lot of these numbers are right there for you if you go online. There's plenty of companies, Dean, like you mentioned, Morningstar, that they already factor it in. They already do the calculation for you. But like you said, years back, if you wanted to find these out, you'd have to go in and do all the calculations on your own. And to find a company's PE ratio, that'd be the share price divided by the earnings per share to get the price to earnings ratio. And this ratio, really what it means and what we use it for is to determine the value of a company's shares, to find out if they're quote unquote cheap or expensive, the stock price that is. In addition to that, you can also find out if a company is more so a growth company, or if they're well established and not focused on growth as much and mainly a dividend yielder. So you can also determine what kind of company it is by looking at the PE ratio, and then obviously in addition to that, if the stock is either undervalued or overvalued. Now, a high PE could indicate that the company is viewed as a higher growth company, or the stock could be overvalued. Usually we see stocks that have higher PEs. They could be in the tech sector, biotech, healthcare, different companies that are more growth oriented. They're going to have a higher PE. Now, again, that could mean that they're simply growth oriented, or they could be viewed as overvalued compared to the overall market or compared to other companies in their sector. So that's another thing that you have to look at. When it comes to now a lower PE can indicate that a company is well established and not focused as much on growth, or that the stock could be undervalued, and that's when a buying opportunity could present itself. So there's really one of two ways to go about it. If you have a high PE, the stock again could simply mean that it's a higher growth company and you could invest in it and it could continue to grow if it's been growing in the past, or it could be overvalued and the chances of it going up in the near term aren't as likely as the chances of it going down if it's overvalued. And again, a low PE means that the company is either well established and not really focused on growth potential as much, or it could be undervalued, and again, that's when a buying opportunity could potentially present itself. But the other thing with PE is we see it all the time where many clients, they look at the value of a stock, a mutual fund, an ETF, whatever it might be. Each one has a share price, and they see a stock, for example, might be $500 per share. There's another one in the sector that might be $50 per share, and right away they think the one that's $50 per share is going to be cheaper. It's a better buy, which, when you're looking at the numbers, it makes sense that way. But really, that doesn't tell the whole story. What you want to focus more so on would be the PE ratio to determine whether or not a stock is undervalued and cheap or overvalued and more expensive, instead of just looking at the share price itself.
Okay, Tyler, good point. And also remember, PE ratios can change over time for a particular stock. For instance, Microsoft years ago was much more of a momentum growth company. It had a higher PE. So if you just analyze the PE alone, you would look at Microsoft years ago and say, it's a growth company and or overpriced. Throughout the years, Microsoft became very much established. And right now we look at it in portfolios and think of Microsoft mainly as a growth dividend production blue chip stock. So what that means is as they become established, they started producing dividends, and that's usually an indicator of a little bit more stability in long-term growth than a higher PE with a no dividend, which typically means this company is reinvesting everything they make back into the company to continue to grow it instead of paying out a benefit, which is a dividend to the shareholders. Okay, we're going to go on to trading volume. This is one we don't hear about a lot from people who have stock portfolios. We believe in it a lot. We look at trading volume. And part of the reason is somebody will come in and say, well, this is a particular stock. I would like to know if, could we add this to our portfolio? Well, first of all, it's your portfolio, but yes, you're going to get advice from us. And many times they don't even think of looking at trading volume. We analyze trading volume all the time. And part of the reason is trading volume is an indicator of potential momentum with a stock. In other words, if it's very thinly traded, means a lot of the shares are not being purchased, so you're going to see stagnation and or sometimes the price going down. Where if you have large trading volume, you typically then see a stock that is carrying some momentum, typically upwards. Doesn't always have to be, though. Unfortunately, momentum can carry them down. But trading volume is also available. You can find trading volume, again, if you look at Morningstar, investing.com, if you look at Yahoo Finance, Google, and so on. Tyler, what else should we talk about when it comes to trading volume and what we scrutinize before we pick a stock when we're looking at trading volume?
So when we look at trading volume, really what it is the total quantity of shares traded for a specific stock during a trading day. Now, if a stock has significant volume of investors buying shares, then the share price is going to increase, the volume is going to increase, people are buying in, they're pushing up the price, therefore pushing up the trajectory and the performance of that particular stock. Now, again, stocks that have a high trading volume, they're going up in price because of the momentum that's pushing them up that way. Many people, again, buying in, and that is termed momentum investing. And that's something that I'm going to touch on in just a little bit here. That's becoming quite a bit more popular. Now, stocks that are stagnant, or if they have a high volume of sellers, that's going to push the price downward, which then either two things happen. That could either be a buying opportunity if the stock is being pushed downward due to trading volume where it goes downward and there's really nothing driving it down, because that does happen, and especially in today's day and age where we're so geopolitically driven, there could be a rumor or a report that comes out and it could drive the stock price downward, but really the stock's underlying fundamentals and the company is still doing well. That could be a buying opportunity. Or if there's a high volume of sellers pushing the price downward, then it might be for a very good reason, and you might want to sell your shares as well. So again, whenever there's downward or volume where the stock is being sold off, pushed downward, it's happening for a reason, and you need to determine whether or not that reason is valid, and you could either buy into more shares, or if it's something that is major in a bad way, you might want to consider selling off your shares as well. Now again, going back to trading volume pushing a stock upward, that means that many people are buying in, the stock is trading at a high volume, and what happens is that can be termed as momentum investing, where momentum investing, it looks at trading volume and attempts to capitalize on stocks that have recently been trending upwards, regardless of their fundamentals. And what I mean by that is many people look at different technical indicators and different charts, where you go back and you find a stock and you look at the performance, you look at charts over the last 5 years, 10 years, 1 year, year to date, and you can see what it's done recently, solely looking at the stock performance and disregarding any of the underlying company fundamentals. Now, fundamental investing looks at a company's financials, and that's what, when I talk about a company's fundamentals, I'm talking about their balance sheet, their income statement, cash flow statement, all the different measures, the PE ratio, dividend yield, a bunch of different measures that look at the stock's fundamentals to determine if the company is desirable regardless of the recent stock performance. So fundamental investing doesn't pay any attention to the volume. It simply looks more so at the company and their fundamentals, whereas momentum investing is really tied in with trading volume, and it looks at stocks that have had recent price movements upward and tries to capitalize on that and hope that it continues to go upward. Because again, we see many clients that they come in and they say, I don't want to buy stock XYZ because it's at an all-time high. Well, that could be very true, but with momentum investing, who's to say that it's not going to rise another 20% in the next couple months? So again, momentum investing is what really plays right into the hands of trading volume, and fundamental investing is the exact opposite, where fundamental investing, they don't look at all at the recent stock performance. They simply look at the underlying fundamentals of the company.
Okay, and before we go on, Tyler talked about fundamentals, and I want to bring up something here too. And that is, you look at all of the numbers and so on, you still have to look at socially what's happening with certain stocks and certain companies. We have a saying, you don't buy stocks, you buy companies. And you need to feel comfortable with those companies. You need to feel comfortable with the sectors they're in. Typically, if you're buying what you think is a good stock in a poor sector, eventually that stock will probably come down just because the sector itself is down. We saw that this last year with the chip manufacturers. Everybody was all over NVIDIA as a stock, early in 2018, late 2017, but because that whole sector came down, it did too. So you also have to look at things outside of just sheer numbers. And I'm going to bring up some examples here. First of all, understand that when you are investing in single stocks, you're taking on significantly more volatility and risk than if you had a diversified portfolio putting in mutual funds and ETFs and bond positions. So understand that if you're going to like the potential gains of single stock, you have to make sure you have the stomach for potential losses. So many times when we put together a single stock portfolio for clients, we will also put in there some no-load mutual funds or exchange traded funds to soften the blow of single stock risk. You still need some diversification. When you look at things outside of the numbers, we talked about trading volume, we talked about PE, but again, socially, you have to look at what's going on. And I'm going to bring up 3 particular stocks. And remember, I am not making any type of claim that these should be added to your portfolio. I'm just using this as an example. But Boeing, right now, Boeing is going through some significant declines in their price due to not their numbers, not their PE, not trading volume at that particular time, not dividend yield. It has to do with, unfortunately, there were some significant accidents that resulted in a cost of life. And they're paying for it in the matter that their stock is going down because their production numbers are going to be going down. So those are some of the things that happen outside of just looking at the numbers. There's also Johnson & Johnson, which is also a very wonderful company used in a lot of portfolios, as Boeing is. Johnson & Johnson is going through an extended period of lawsuits over the talcum powder potential cancer scenario. And then there's a company called AbbVie. AbbVie is a wonderful company. It's spun off from Abbott Labs some time ago. AbbVie is the manufacturer and maker of the patented Humira drug, which has been leading the market for a number of years. But because Humira is going to be coming out of patent in the year, I think, 2022 or 2023, the market is already preparing for that and has sold off. So the numbers look spectacular on AbbVie and look very good on Johnson & Johnson and Boeing, but there are things outside of the numbers that you have to look at too. Is it a buying opportunity? Could be. Don't just look at a stock that goes down saying it's a good buying opportunity without knowing what's going on. There's an old saying, I think it was Warren Buffett, I'm not quite sure, it's buy on bad news, sell on good. And that could be an opportunity, but make sure that you also look at socially what's happening with these particular stocks. They might be going down for a good reason, and it might not be a good buy when they're down.
Yeah, Dean, very good examples there. Before we go on to our next important financial term, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, we're back, and now we're going to talk about some terms as it relates to not only investing, but some of your retirement plans. We're going to look at next the terms of contribution, transfer, and rollover. Now, these are three terms that, unfortunately, many times people get confused with. Okay, the first one we're going to talk about is a contribution. And a contribution, many times you hear about this during tax time. Why? Because your tax advisor or CPA or accountant says if you contribute to a traditional IRA, you are going to reduce your reportable income down, which means you're going to be paying less in taxes. We like that idea because you're also adding to your potential retirement funds when you do retire. But Tyler, what else on a contribution should we know?
Yeah, Dean, so when it comes to contribution, transfers, and rollovers. Contribution, now that's money that comes from your checking or savings account that you use to add to a retirement account. So that's the important term there. You make a contribution, you add to it, it's money from checking or savings. Now, in 2019, you can contribute up to $6,000 in a traditional or Roth IRA, or $7,000 if you're 50 or older. And again, you can only make contributions to retirement accounts if you show earned income is the other key there. But what a contribution is, again, it's money that you add to a retirement account. With it being tax season right now, as you said, Dean, many people, they're going in, meeting with their tax preparers, and you can make a contribution to a traditional IRA. So again, money from checking or savings that you can add to it, and you can get a tax deduction now and take that deduction. Or with a Roth IRA, you don't get one now, but you do have the money grow tax-free, and you can utilize that tax-free in retirement down the line. So again, contribution is money that you add to a retirement account coming from checking or savings, and that differs from transfers and rollovers. And transfer is the next one that I want to talk about now, because again, you hear it from time to time. There's many people that we know and many clients that we've helped transfer accounts, and what that means is money is already invested in an investment account that transfers directly to a new company. It's mainly referred to as a direct transfer. And a direct transfer is where you might have an IRA or a Roth IRA, for example, at one company, and you want to transfer that account to another company for whatever reason. They might have better services, lower fees, better investment options. It might suit your needs better. For whatever reason you want to transfer it, then all you have to do is simply fill out transfer paperwork, and the money transfers directly from the first company to the second company without any taxes or penalties. And with a direct transfer, the money never touches your hands. So it goes directly from the first company to the the old company to the new company without touching your hands. It's a direct transfer, and if the paperwork is done correctly, it's not going to touch your hands, and there are no taxes that are paid with that either. So again, direct transfer is money that you might already have an IRA or a Roth IRA somewhere, and for whatever reason you're not too content with it, And if there's a better company, then again, a direct transfer is what would take place there. So that's if you already have an existing one, you're not adding to it. It's not through an employer-sponsored plan. It's already in an IRA or a Roth IRA. You're simply transferring it over to a new company. So that's a transfer.
Okay. Now, the next one we're going to talk about is rollover, and Tyler's going to explain the rollover, but there's one thing we want to make sure everybody understands when it comes to a rollover. Many times at the time of retirement or prior to retirement, even though you're still working, if you're over 59 and a half years old, there is a policy out there called an in-service withdrawal. And what that means is while you're still working, you have the ability from many employers to take your retirement account, your corporate-sponsored retirement account, which could be a 401k or a 403b, and you can roll that over into an independent IRA outside of your company's retirement plan, something that's more specific for retirement, something that can be risk managed a little bit more or actively managed. So that process is out there, and it's available for many, many people over 59 and a half years old. So before we go into rollover, I just wanted to make sure that you understand rollover doesn't always happen at the point of retirement, termination, or just quitting a job.
Exactly. Good point there, Dean. Now, when it comes to the difference between a contribution transfer and a rollover is money that you have in an employer-sponsored retirement plan through work that you roll over into either an IRA or a Roth IRA. So again, when you roll over money, it's money that originates through your employer, whether that be a 401k, a 403b, profit-sharing plan, pension, 457 plan. It's something that was started through your employer, and you can most commonly, the most common way that people roll over accounts is you have to terminate employment, except for a couple of reasons. And Dean, you just mentioned the scenario. There are in-service withdrawals available, but the most common way that people roll it over is after they terminate employment. Now, that might be through either retirement, is just probably the most common, or a change of jobs, or if you quit jobs. If you're no longer employed, then you have the option to roll it over. But again, you have to terminate employment first, with the exception of a few different scenarios where you don't. But again, if you do terminate employment, not always, but usually if you're no longer working for a company, your money shouldn't be working for them either. So you should take advantage of that. But again, not always, in most cases. Now, with a rollover, you can roll over your 401k, for example, to a traditional IRA, and you don't pay any taxes. But what happens here, how this differs from a transfer, is that the money is in an employer-sponsored plan, number one, and number two, what happens is the 401k custodian, so the company that holds your 401k, they typically will cut you a check. So however much you have in your 401k, when you request a rollover, they will cut you a check and they will send it directly to your mailbox, and then you have 60 days from the time that they cut that check to deposit it into your IRA account. So again, with a direct transfer, the money goes directly from the old company to the new company. With a rollover, you request the rollover, and then the money goes to you. That check actually will go right to your mailbox, and then you have 60 days to then deposit it into your IRA account.
Okay, Tyler, good point. But one thing we want to make sure you understand, when Tyler's saying that the check is cut to you, many times, for instance, we use as a custodian to hold money for our clients. We use TD Ameritrade as an example, but there's Fidelity and Schwab and Vanguard out there. There's many others. But what happens when you roll your money over from the custodian who holds it with your employer? They typically write the check out to the custodian you're going to. So for instance, if it's being held at Fidelity, they will write the check out to TD Ameritrade, FBO, for the benefit of, and then they have your name there. So what happens on that check is it marries your name to the custodian who holds it. So even though the check is going to be mailed to you, typically, not always, but typically, for a 401k rollover, it is not made out just exclusively in your name. You do not want that. If you do that, then it could become a taxable event. So again, a rollover should be done correctly. Meet with a financial professional. They'll explain whether, first of all, a rollover is in your best interest or a rollover isn't in your best interest. We've seen it a lot where people wanted to retire or lost their job between 55 and 59 years old, and their financial advisor tells them to roll over their 401k. That is not a good thing to do in a situation like that, because between 55 and 59 and a half, if you don't get another job and you need that money, if you roll it over into an independent IRA while you're between those years, you are going to have a 10% penalty if you start to withdraw from that account. However, you have one opportunity to keep it with your employer plan. And if you lose your job or retire between 55 and 59 and a half, you can withdraw money from that original account with your employer and not have the 10% penalty. So make sure that you meet with a professional to go through the reasons for rolling over and the process to roll over the accounts.
Yeah, Dean, good points there. It's important to know the difference between contribution, rollover, and transfer. Now, the last one that we have time for today is going to be the last important financial term, that is RMD, which stands for Required Minimum Distribution. Now, just real briefly here, because we talk about this one a lot, but we make sure our clients are aware of it because it is very important. In RMD, again, Required Minimum Distribution, that's the amount that the owner of an IRA or qualified retirement plan must begin withdrawing from their account in the year they reach 70 and a half years old. So again, when you turn 70 and a half, you have to start taking money out of a pre-tax retirement account, such as an IRA, 401k, 403b account. And that amount you have to take is a calculation based on your account value as of the end of the prior year and your age. So you have to start taking it in the year you turn 70 and a half, and you have to take it every single year thereafter. The first year RMD amount is about 3.65% of your account value. So hypothetically, let's say you had an IRA valued at $200,000. The first year, 3.65% of that is $7,300. So $7,300 is what you have to take out of it, whether you want to or not. And the reason why RMDs are such a big deal is because if you don't take it, it's the steepest IRS penalty that I know of. And so if you forget to take your RMD, the IRS imposes a 50% penalty on what you should have taken. So for example, the $7,300, if you have $200,000 IRA account and you forget to take it, the IRS then penalizes you 50% of that $7,300, or $3,650. And that's definitely a bill that I don't want to pay. So again, RMDs, when you turn 70 and a half years old, is something that you really want to be aware of. We make sure all our clients are aware of that, and we help them out with that. But required minimum distribution is another important financial term that we want everyone to be aware of.
Okay, that's all the time we have this week. See you later, and hope you'll join us again next week.
See you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.